This is not financial advice, educational content only. Most Fed coverage focuses on the FOMC decision, the rate target, the statement language, the press conference. The thing that actually moves bank reserves on a week-to-week basis is often separate from all of that. It's the Treasury General Account, the US Treasury's primary operating checking account at the Federal Reserve Bank of New York. When that account fills up, bank reserves drain from the system. When it empties, reserves flow back in. That's not a policy decision. It's arithmetic. The balance is public, published daily by the Treasury and weekly by the Fed, and it can swing by hundreds of billions of dollars in a matter of weeks, changing reserve supply by the same order of magnitude as a medium-sized Fed policy action. Let's look at the mechanics. The Federal Reserve's balance sheet is a T account. On the asset side, Treasuries, agency MBS, and other holdings. On the liability side, currency in circulation, bank reserves held at the Fed, and a set of other accounts, including the Treasury General Account. The key identity when the Fed's assets are roughly stable, a change in the TGA is largely offset by a change in reserves in the opposite direction. They're the two largest fluctuating liabilities on the same balance sheet. Here's the mechanism in practice. When the Treasury receives tax payments, money moves from taxpayer accounts at commercial banks into the TGA. The commercial bank's reserve account at the Fed is debited, the TGA is credited. From the commercial banking system's perspective, reserves fell. From Treasury's perspective, its checking account grew. Same transaction, two effects. Run it backward, Treasury pays out Social Security, defense contracts, interest on outstanding debt. Money flows from the TGA to reserve accounts at commercial banks. TGA falls, reserves rise. The Federal Reserve tracks this in its H4.1 statistical release, formally titled Factors Affecting Reserve Balances, published Thursday afternoons, covering the prior Wednesday balance sheet. The TGA appears under US Treasury General Account in the table of factors absorbing reserves. The same balance appears in near real time in the Treasury's Daily Treasury Statement, published around 4 p.m. Eastern Time each business day on the Treasury's Fiscal Data website. Both are primary sources, both are free. The scale of TGA movements becomes clear in the COVID period. Congress authorized multiple rounds of relief spending beginning in 2020, and the Treasury needed to pre-fund that spending before disbursements went out. Rather than running near its historical operating balance, which had been in the low hundreds of billions, Treasury built the TGA to roughly 1.6 to 1.8 trillion by mid-2020. I'm citing that range from H4.1 data at the time. The exact peak is in the weekly releases, and I'd point you to that primary source for precision. What that buildup did as Treasury issued debt to raise cash, money flowed from private sector bank accounts into the TGA. Reserves fell. The effect was mechanically similar to quantitative tightening. Reserve supply contracted, though the cause was Treasury's cash accumulation, not Fed policy. Then Treasury drew it down. Through the second half of 2020 and into early 2021, the TGA contracted from roughly 1.6 trillion toward a much lower level. That drawdown reversed the flow. Reserves surged back into the banking system over a compressed period. The magnitude was extraordinary. Hundreds of billions of dollars of reserve injection in a few months, running independently of anything the FOMC decided. By the time that reserve surge intersected with the Fed's already accommodative balance sheet, the system held reserves far above the range the monetary policy framework was calibrated for. The overnight reverse repo facility, which absorbed over $2 trillion at its 2022-2023 peak, was in significant part absorbing the excess reserves that Treasury's drawdown had injected. That's my read. The debt ceiling creates a distinct and recurring TGA dynamic. When Congress reaches the statutory borrowing limit, Treasury cannot issue new net debt. It uses extraordinary measures, a set of accounting deferrals involving certain intragovernmental accounts, to buy additional time. Treasury publishes formal notifications to Congress when it begins using these measures. The primary source is the Treasury Secretary's letters to Congress, posted on the Treasury website. During the extraordinary measures period, Treasury often manages its cash balance down aggressively to fund ongoing operations. The TGA can fall to very low levels. In the weeks before the June 2023 debt limit suspension, for example, the balance fell to roughly $20 to $30 billion, near a minimum threshold below which Treasury cannot reliably cover daily operations. I'm citing that range from H4.1 releases at the time. Check the primary source for precision. When the ceiling is raised or suspended, Treasury immediately needs to rebuild the account. It does this through a surge in Treasury bill issuance over a compressed window. That T-bill issuance pulls reserves from the banking system as investors purchase bills with money from bank deposits. The reserve drain from a post-ceiling TGA rebuild is fast, moving and predictable in direction once the ceiling deal is struck. In the June 2023 episode, the T-bill surge coincided with ongoing Fed quantitative tightening, two independent mechanisms draining reserves simultaneously. Whether the additive effect drove specific market stress in that window is something analysts continue to debate. The direction of the pressure was unambiguous. That's my read. The TGA's interaction with quantitative tightening and easing complicates what reserve data tells you. In QT, the Fed lets maturing assets run off without replacement. The balance sheet shrinks on the asset side, reserves fall correspondingly. The intent is to drain excess reserves toward a level consistent with normal monetary policy transmission. But if the TGA is simultaneously being drawn down, injecting reserves, the headline reserve number can appear stable or rising even as QT is in progress. The policy tightening is real, the reserve aggregate is masking it because two opposing effects are partially offsetting. The inverse also holds. In a QE program, the Fed buys assets and creates reserves. If Treasury is simultaneously building the TGA through heavy debt issuance, reserves absorbed by that TGA buildup offset some of the reserve creation from asset purchases. QE appears smaller in its reserve supply effect than the nominal balance sheet expansion suggests. This is why reading the H4.1 in full form, not just the bottom line reserve number, matters. The factors affecting reserve balances table itemizes each element separately: currency in circulation, the TGA, the reverse repo facility, float, and other factors. Reserves are the residual of everything else. To understand whether reserve conditions are tightening or loosening, you need to track the full table. The Fed also publishes a daily liquidity factor data series on its website that updates these figures between weekly H4.1 releases. What the TGA alone can't tell you whether reserve levels are tight enough to create funding market stress. That answer depends on how reserves are distributed across institutions and whether banks are willing to lend them at the margin. A question that shows up in money market rates, not in balance totals. Here's how I track the TGA in practice. That's my read. Weigh it as you see fit. I treat the TGA, the reverse repo facility balance, and the Fed's total asset level as three interlocking liquidity indicators that together tell a more complete story than any single one. All three are in the H4.1 published every Thursday. None require a subscription. Three signals I watch for: first, a rapidly rising TGA combined with a shrinking reverse repo balance in the same H.4.1 release suggests reserves are being absorbed by Treasury cash buildup while excess liquidity elsewhere is already depleted. That's a reserve tightening signal operating entirely outside FOMC decisions. Second, a large post-debt ceiling TGA rebuild, identifiable because it follows a publicly announced ceiling deal, creates a predictable window of T-bill issuance pressure. The pace of the rebuild, measured against the size of the deal, gives you a rough timeline for when reserve drain peaks. Third, a TGA near a minimum operating level suggests Treasury has limited capacity to inject reserves through cash drawdown. Whatever reserves come in going forward will depend on spending, not on Treasury's ability to further drain its account. The broader framing monetary conditions at any given moment reflect at least three simultaneous processes: Fed policy, balance sheet, and rate decisions, Treasury cash management (TGA) dynamics and private sector liquidity preferences reflected in money market rates. Fed coverage tends to treat the first as the story and miss the other two. In periods where the TGA is moving by hundreds of billions in a few months, that's a significant omission. That's my read. Real tool for the next debt ceiling episode or T-bill issuance surge. Pull the H4.1 release on Thursday afternoons from the Fed's website. Search Point 4.1 Federal Reserve Statistical Release. Find the line US Treasury General Account in the factors table and track it week over week. If it's rising fast, reserves are draining independently of FOMC. If it's falling fast, reserves are building. Pair it with the reverse repo balance, same table, for a complete picture of short and reserve supply from free public sources. I'm Diane, back next briefing.